This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, at the very beginning of this chapter, a long time ago now, I'm sure you believe, but we outlined 3 different types of relief that we'd be dealing with within the chapter. And those categories of relief came in the following 3 categories. They were, firstly, a reduced tax rate. We saw that with business asset disposal relief and, where appropriate, investors relief. 10% instead of a higher rate of 20% that would otherwise have applied to such gains. We then saw the deferral reliefs, allowing a gain that had arisen on a chargeable disposal that had arisen now to be deferred to a future point in time, either through rollover relief or through gift relief. With gift relief as well, not only was the gain deferred, but it became the responsibility of the donee. The donor made the disposal, but because there was a gift, it was a gift that was involved here, then that gain in full, or maybe at least in part, was able to be deferred. Not only did it put off the chargeability of the gain to a later, a future point in time, but also it removed the responsibility from the donor and put it on the shoulders of the donee. Now those reliefs were great. But the third category, and now the final relief that we see here in our notes, private residence relief here, well, that is as good as it gets. Because what this is all about is an exemption, an amount of gain that won't be chargeable at all. It's nice if we can defer gains to a future point in time, but at some point it's going to come back to haunt you and that gain will be chargeable. It's nice if we can reduce a tax rate that would have been 20% down to 10%, but it's a whole lot better if we can avoid any taxability whatsoever, not just now, but also for the future. And that's what we have with private residence relief. Now, clearly, private residence, we're talking about residential property. And what we've seen within these notes, back in chapter 12, indeed, we got introduced to some of the detail, but also the concept of private residence relief, we have seen some critical issues. 2 of these issues have been very bad news so far as the taxability of residential property is concerned for any individual taxpayer. They were, first one here, that higher CGT rates would apply. Any such gain falling in the basic rate band, or the remainder of that basic rate band, of course, for the taxpayer, would be taxed at 18% instead of 10%. And any such gain on residential property that falls within the taxpayer's higher rate band, which in most cases will probably be all of it, but that would be 28% instead of 20%. So we had higher CGT rates. Not only did we have to pay more tax on the disposal of residential property, but also then a payment on account would become payable in relation to gains arising on the disposal of such residential property. But what we now see is, and as was mentioned back in chapter 12, as well as dealing with the detail of those first 2, there's something called private residence relief, which in real life will apply to the vast majority of the huge amount of transactions there will be where taxpayers dispose of their private main residence, the property in which they live, their home, during the tax year. That 100% of such gains made on such a disposal will attract 100% private residence relief. Because all you've ever done from when you bought to when you sold is what most people do. They live in that property. Now, clearly, although that is mostly what happens in terms of the vast majority of taxpayers within any tax year, it's 100% relief. Effectively, the disposal is exempt. What we're going to find, of course, in an exam question is it's not quite that easy. That what we're going to have is some, but not all of the gain, ranking for private residence relief. Now, what that is going to be based on, as we'll see within the notes in a moment, is whether or not you have occupied that property throughout the period of ownership. So there's going to be a lot of dates in this. You're going to be getting your fingers and thumbs and toes, whatever, out there and trying to count through how many months is it where this happened, where that happened, where the other happened. And in terms of those events, does that represent occupation, which would either be actual, clearly actual occupation, therefore will be fine for private residence relief, or the main thing that you've got to learn in terms of this subject, and it's not a huge list that we've got, is that although there may be periods of non-occupation, depending on what they are, they may be classified as deemed occupation. So the reason why you are not there is permitted, maybe with a time limit placed upon it, but will in fact be classified as occupation even though you didn't actually occupy. But that would be mostly to do with the reason why you are not living in that property for that period of time. So anything that is either actual or deemed occupation will be an exempt period. Anything that falls outside of those parameters is non-occupation and will therefore be chargeable. And you can bet your life here that in terms of any such exam question, there will be some period that does fall out of the context of actual or deemed occupation. It is, for this purpose, non-occupation, and therefore you will not have private residence relief on the entirety of the game. And some time apportion will have to be done. So as I say, this is where it gets tricky. You can't really use your calculator on this one so much, where you are looking at from that date to that date, actually did the property. How many months is that? From that date to that date, didn't live in the property, but what was the reason why they didn't live in the property? Now then, is that one of the reasons that I have learnt that actually classified as deemed occupation, so actually it will go in as occupation, it will be exempt. Then from that date to that date, didn't live in it, what's the reason as to why? It isn't a qualifying reason, it isn't deemed occupation, and therefore it's non-occupation. And anything that goes into that column of non-occupation, or you may choose, as we'll see in a moment, the title chargeable there, is going to create chargeability. So we're going to have to look at what's the total period of ownership from when you bought to when you disposed of that property. And again, we'll measure that in monthly terms. And we've also got to look within that period of ownership, how many of those months of ownership rank as occupation. And that is, as we've said, either actual or deemed. And you're going to have to keep a list of those particular months. We'll have two columns, headed, if you like, exempt chargeable, or occupation, non-occupation. And you go through the issues raised within the question. Bought it on this date, lived in it. That's actual occupation. How long did he live in it for? 5 years. 5 years, 12 months per year, so that's 60 months of occupation. Then went away. What was the reason? That's where the next bit comes in. As I say, the bit that you're going to have to learn is, will that period be either in full or in part classified as deemed occupation? Anything that falls outside of that categorisation of deemed occupation is going to be non-occupation, therefore it's not going to be exempt, that's going to be chargeable. So let's have a little look now at the detailed note to see what we have on this. The sale of an individual's only or main private residence is covered by private residence relief, or PRR as we may know it from now on. That relief also covers grounds, gardens therefore, up to half a hectare. That can be bigger if you've got a stately home, for example, I'm sure we all have. Then on that basis, just to get around the property might be more than half a hectare there. Well, again, that can be adjusted. It can go up there if, again, the nature of the property is such that, yes, you would need a bigger grounds, a bigger garden. But otherwise, if you've got your house sitting on a plot of half a hectare, when the disposal is made, if it's the ordinary course of events, i.e. you bought it, you lived in it, you sold it, then all of the gain on the entirety of the disposal consideration, less the allowable costs, the entire gain will be covered by private residence relief. Given that this is likely to be an objective testing rather than a written question, it's probably not likely that you'd have this particular planning issue, but imagine for a moment that if you had that property, the house, and you had your half a hectare of ground, and that was a very large garden, as it would be maybe within a city, and it was a very desirable area, and what you could do therefore is maybe sell off half of the garden, and that therefore may give rise to a gain. That would be covered by your private residence relief. So if I've got my house, I've got my garden, I sell off part of that garden for building development, then any gain made on that would be covered by the private residence relief there. But if, on the other hand, I were to sell off the property and with it half of the garden, that would get private residence relief. Now what I'm left with is just owning the other half of that garden, which I am then going to sell for investment purposes. Then at the time you make that future sale, well, it's no longer your private residence. Therefore, you've sold it, and therefore you don't get the private residence relief. But that's probably more likely as a discursive issue. Hard to test that in terms of an objective testing question. Therefore, probably is more at advanced tax. But for the sake of a couple of minutes, it's worth just a quick mention. All right. The relief is available in full if the taxpayer occupied the property throughout the entire period of ownership. So again, what we're going to have to do is the easy bit, calculate the gain. What do we sell it for? Less the selling expenses, get the net proceeds. What then are our allowable costs? What did we originally pay for that property? Were there any other purchase costs like legal expenses, which there would have been involved there on any such asset purchase? Any and all allowable costs? Was there any enhancement expenditure? Again, during the period of ownership, have you enhanced, not simply repaired, that's revenue expenditure, but you've had capital expenditure? Yes, you put a kitchen extension onto the property. You have built an extension to the property, like a conservatory, or built a garage, or whatever. That would be capital expenditure, all of which would be allowable expenditure to then deduct from those net proceeds to give you the gain. As we've said, having got that gain, that is usually then going to be fully covered by private residence relief. But it won't be in your exam question, because we will have this difference between the overall period of ownership and what's classified as occupation. And as we say here, where occupation has been only part of the period, a proportion of the gain is covered by the relief. So that's the basic calculation that we need to do there. Now the gain, you know how to do that. That should not be a problem. The period of ownership, when did you buy, when did you sell? Now, as long as you can do dates and either on your fingers to get the number of years and then number of months, and then maybe through a calculator, that many years times 12 is this many months, add on this many months, that's the period of total ownership. Other than making a mess of the calculations, that again is not difficult. Most of the technical work that you need to do here is all about that one, the period of occupation. Because as we have said, there are what are periods of absence which are still deemed to be full occupation. So what are they? This is the bit that you need to learn and then know how to apply. They are, firstly, the last 9 months of ownership will always be classified as deemed occupation, so far as we're concerned, so long as the property was the individual's main residence at some point in time. You can't just buy a property, sell a property, and get the last 9 months of that period of ownership as an exemption in terms of deemed occupation. If you never lived in it, if you never took it on as your private main residence here, then you won't get any such relief. Again, the situation you're going to find is it will be a property where you bought it, and even if not immediately moving in, there was a period of actual occupation that made it your private main residence, and that therefore will allow the last 9 months of ownership up to the date of disposal there to be classified as deemed occupation. The only other main reasons for which now there will be deemed occupation, and these are the big ones here in terms of allowability, will be why would you leave your property? It's your house, it's where you live. Why would you leave that property and yet still keep ownership of it? And the main reason that we get as an answer to that is because of work. You are required to go and work elsewhere. Where might that elsewhere be? Well, in these terms, it is simple. It is either overseas or it is elsewhere within the UK. So in which case, any periods during which the individual was required by his employment to live abroad, I've taken a job in Australia for 2, 3, 4, 5 years, whatever, that will classify as deemed occupation there. Any period up to 4 years during which the individual is required to live elsewhere in the UK due to either employment or self-employment. So again, I haven't gone overseas, I've just gone to somewhere else in the UK. And if therefore my main residence that I bought, I lived in it, was in, say, Birmingham, close to Villa Park, the true centre of the universe, you'll know. If it was there, and then a job came up in Manchester, in Glasgow, in London or whatever, and I went to do that particular job, but I kept the family home there. Maybe if my wife and the kids came with me, I let that property out or whatever. But I keep the property while I go and live and work elsewhere in the UK. If that happens, then we have this limitation here of up to 4 years, during which the individual is required to live elsewhere in the UK. So if therefore I moved from my main residence in Birmingham and I went to London to live and to work, and I spent 5 years there prior to returning once more to that property to live in it, I would know that 4 of those 5 years, some 48 months out of the 60 months that I've been working in London, would still be classified as deemed occupation. But if I've got over the 4-year limit, remember there is no limit for overseas work, but I've got over that 4-year limit for work elsewhere in the UK, is that going to create chargeability? It may, but it may not. And that is what this last one comes down to here. Up to 3 years for any reason. So, that therefore, I was away for 5 years. Why was I away? I was working elsewhere in the UK. 4 of those years classify as deemed occupation for that reason. Employment as it was, could have been self-employment, but working somewhere else in the UK. And the remaining 12 months, the remaining 1 year, may attract 12 months, 1 year's worth of this total of 3 years for any reason. And that's a total for the period of ownership of the property. You can't go away for 3 years, come back for a year, go away for another 3 years, not for reason of employment. You just like travelling. Wish we could all do that. But that wouldn't work. Again, that 3 years is a total there that we're talking in terms of. So how do we know whether that for 3 years, for any reason, will apply? And that's where these last little bits here, in terms of these points, B and C, and then B, C and D, come into play. Just a little bit more learning that you've got to do. Points B to D there must be preceded and followed by periods of actual occupation. I bought the property, I lived in it, I went to Australia for 10 years to work, I came back, therefore I've got actual occupation both before and after. I went from Birmingham to London for 5 years, lived in it before, lived in it after, I've got actual occupation. With the 5 years in working in London, only 4 of those 5 years were going to be classified as deemed occupation under this point C here. But that's where this one, D, comes in. Remember, this is points B to D. Up to 3 years for any reason. Now, this is where this issue of actual occupation preceded and followed. So if, therefore, when I went away for 5 years to work in London, I returned and I lived in my Birmingham property before I sold that property, then I would be entitled to this 3 years for any reason. I'd also, of course, be entitled to the 4 years for working elsewhere in the UK. But it's that point D that is critical about living in it both before and after the period of absence. For any of these B, C or D to apply, you must have actually lived in it. It must have become your private main residence here before you went away for any of these reasons. That's a given. But do you have to then live in it after that period? And that's where these last couple of rules come in. But for points B to C, these are the employment stroke self-employment ones, not this one. This is just B to C. If the individual could not reoccupy due to the terms of employment requiring them to work elsewhere, then by concession, the condition of actual occupation following the period of absence is not applied. Now, what that means is, if I lived in my property, I then went to Australia for 10 years. I decide, you know what? I'm not going back. You know, I like the culture here in Australia. Well, maybe, but at least I like the weather. I'm not going back. The HMRC are not going to say to me, in which case, if you want that 10 years of your work elsewhere, overseas, that 10 years of work in Australia, if you want that to classify as deemed occupation, which of course I do, I don't want to be paying a huge amount of tax on a huge gain here on that property when I sell it, then this concession means that if I am still in that employment, or it doesn't have to be the same as the one when I left, but I'm in employment in Australia, I do not have to leave that employment, come back to the UK, live in the property before I sell it, to get that any period spent working overseas as deemed occupation. I don't have to come back. In terms of, I go to London for 5 years. I decide, you know what, I'm going to stay in London. I'll sell the property in Birmingham. I just have to drive back every couple of weeks to see the home games for the Villa, but I can do that. I'll sell the Birmingham property, therefore. In which case, again, if the reason is because of the work that I am doing, then they don't make me, HMRC don't make me, uproot from my employment in London, come back to Birmingham, live in the property again, and then sell to get that 4 years of deemed occupation applicable. So if the reason why I am away and I don't return to the property prior to sale is because I'm prevented from doing so because of point B or point C, basically I am working either overseas or elsewhere in the UK, I am not forced into leaving that work, coming back, living in the property. I don't have to do that. I can still sell the property while away from it, and I'll still get the period for working overseas and the period for working, well, up to 4 years anyway, in the UK. But in my situation, I went to London for 5 years. Now then, if I decide after that 5 years, while I'm still in London, that I'm not going back, I will be fine with my 4 years for working elsewhere in the UK. But the 5th year there will be chargeable. Unfortunately, this one, up to 3 years for any reason, will not apply. Because as we've seen here, that points B to D preceded and followed by periods of actual occupation, but it was only points B and C that had the concession that I didn't actually have to return to the property to get that deemed occupation. But if I want this one up to 3 years for any reason, then that does require me to take up actual occupation prior to disposal of the property. For the employment ones, if I'm still working overseas or in the UK, I don't have to leave that work. No, that's fine. I'll still get those deemed occupations periods in points B and C. But if I'm reliant here on point D, the 3 years for any reason, then that will require actual occupation to take place prior to a sale. Now, don't worry about questions here in terms of, well, how long do you have to live in the property? How long do you have to return for? There is no set period that is written in terms of the legislation. It just requires actual occupation. So don't worry about that. It will be clear within the question whether or not the individual has or has not returned. Again, as advanced taxation, it may be you're giving advice, as you should do, before the individual sells the property. And you're identifying, we have a problem here, that if you don't return to the property this period of 1 year, 2 years, up to 3 years there, that period is going to be chargeable. You won't get the exemption in terms of 3 years for any reason. If you want that, then you are going to have to return and live in the property. But again, you will not have to specify any periods of time. So that's the bit there, these points that you're going to have to learn. And again, that concession that you do not have to leave your work either overseas or elsewhere in the UK to benefit from those periods of deemed occupation outlined, as we've seen there, in points B and C. But if you are looking to get the benefit of point D, the 3 years for any reason, then that will require some period of actual occupation following the period of absence if you are to benefit from that deemed period of occupation. Okay. What you are likely to see in an exam question is not advising the taxpayer prior to a sale, but as a result of the sale, is there going to be any chargeability, and maybe computing even the CGT liability that would arise. And most of that is going to be dates. It's going to be working in months what is classified here as either occupation, actual or deemed. That will be exempt. And what is non-occupation, what falls outside of the parameters of deemed occupation, and therefore will be chargeable. And what you're going to have to do is to run, as it were, down the left-hand side of your page, dates. So from when you bought to another event. So when you bought it, you lived in it. And then 5 years later, you moved out. That is actual occupation. You then look at the period you were away. Why were you away? You were away because you were working overseas. It could be 3 years, it could be 6 years, it could be 12 years, whatever. There's no limit on that. Then you came back, you lived in that property. You then went away again, and maybe you didn't come back. If you didn't come back, then you'll always get your last 9 months because at some point you had lived in the property. But if you go away for some other reason, you decide to go travelling there to discover yourself. You're not going away for reason of work there. You're gone away because you're fortunate enough to be able to afford to do that and go travelling. And you decide, therefore, that while away you will sell. Then you won't get the 3 years for any reason because that does require actual occupation prior to the sale. So you've got a little example here where we simply got to calculate the chargeable gain that will arise. Now again, it comes in different parts. One, you've got to calculate the gain that has arisen in relation to that property. That's a simple, what's my sale proceeds, what are my selling expenses, what's my net proceeds, what are or is my allowable cost or costs there. Get the gain. Then the main part of the exercise, how much private residence relief? You need a working, where, as I've said, you will track down the left-hand side of your page, date to date. Is that occupation? Is it actual or deemed? Or is it non-occupation and therefore chargeable? And you'll go through each of those periods in turn. And sometimes you might, for example, get, if I went away 5 years for working elsewhere in the UK, I could have 4 years of that period as deemed occupation because it's 4 years working elsewhere in the UK. And if I had returned to the property prior to sale, then the 5th year would be, well, that's 1 year for any reason. It's less than 3, so I don't have a problem there. If I didn't return to the property, then that 12 months, that last year, would not be going in the deemed occupation, the exempt column. It would be going in the chargeable column there. Okay, so what I want you to do is, as we look through this information, you've got to work out the gain. So you need to know, there's the cost, 1st of April 96, £10,000. They tell you then what happened before, again, sold on the 30th of June 20 for 150. So all you've got there is cost, proceeds. What you may have, of course, is cost, other enhancement expenditure, eventual sale proceeds, and selling expenses incurred to deduct from those proceeds. So that could be a slightly more interesting calculation. But most of the work is this. There is the date that you bought, and there is the date that you sold. So the first thing you can do is, from that date to that date, in months, what is that as a period of ownership? What we'll then do is to fill in for each of the bits of that period of ownership, whether those bits represent occupation or non-occupation. And that, as I say, could be exempt or chargeable, either title in terms of your working. This is an objective testing question. There are no marks for working, so it doesn't matter what you call it anyway. But what have we got there? Lived in it until the 30th of June 96. So on your working, down the left-hand side, the first thing you've got is, left-hand side of your page as it were there, is 1st of April 96 to 30th of June 96. That therefore is however many, that's what have we got? Lived in it, that's 3 months there, 3 months of actual occupation. He then worked abroad for 2 years and then moved back into the property. 2 years, deemed occupation. It could have been 2, could have been 4, could have been 6, could have been 12. It's work overseas. So all of that is going to be deemed occupation. Came back on the 1st of July 98. So that's, again, 2 years. 24 months deemed occupation. Lived in the house until the 31st of December 2004. Convert that to months. How many months is that? It's actual occupation. And then, before leaving to live and work elsewhere in the UK, David did not return to the house, and the house was sold on the 30th of June 2020. You may assume that he is still working elsewhere in the UK, but he hasn't returned to that property. So for that period, how much of it is going to be classified as exempt, as effectively deemed occupation? Out of points A, B, C, D, what can you get there in terms of deemed occupation? And anything other than that for that period, that's chargeable. That's going in your chargeable months column. It will mean then that your private residence relief is computed as, in monthly terms, let me just take you back to this calculation up here. You know what your capital gain is. That in this was what, 150 less 10, so 140,000. You've already worked from date bought to date sold. You know the period of ownership. From the working that you do, where you're going through those different periods, in, out, shake it all about, whatever it is there, then you have ascertained what is both actual and deemed occupation. That's your top line. And that will be your private residence relief. That relief, you can deduct that figure from the gain you computed, which will leave you with an amount of chargeable gain. We do not have to take this exercise any further. Obviously, that chargeable gain would then be chargeable, and as it's on residential property, it would be at the higher rates, of course. Of course, before you get the taxable gain, you'd need to know about the allocation of any losses. the allocation of your AEA. If there's nothing else there, you know what you do with the AEA. Okay, I'd like you to draw up that little working therefore and attempt example 11 just for yourself. Before then, I'll, again, when you've done your attempt, we'll have a look together at the model answer, so come back and join me then. Okay, well, let's see how we got on therefore with example 11. It comes basically in two parts. First of all, you compute the basic calculation of the capital gain in relation to the disposal of your private residence. Again, it was a simple one here. You sold it for 150, you bought it for 10, gain therefore 140. You might anticipate, as we said, we suggested earlier, a slightly more interesting calculation there, where here's your proceeds, here's your selling expenses, take those expenses away to get net proceeds, here's the original cost, here's some enhancement expenditure, put those two together to get the overall allowable cost, and in that way end up at that point with a gain. But the real hard work is here, in establishing how much of that gain will be eligible for the private residence relief. So we run a couple of columns here to work out in monthly terms how much of the period of ownership, which again we can establish from, as we said earlier, when did you buy, when did you sell, how much of that period will be classified as occupation. Now we can head these two columns, again, actual and deemed occupation, it will of course be in months, or their absence, non-occupation, or just exempt and chargeable. Again, unless this is a section C question, they're not seeing you working, so it doesn't matter what you call it, as long as you know the difference between the two lists that you compile, then that is fine. So what do? We bought it on the 1st of April 96 and lived in it for just 3 months through to the 30th of June 96, so that's 3 months of actual occupation. We then went to work overseas for 2 years, another 24 months of now deemed occupation. Again, that is exempt. We then got actual occupation again for the period from the 1st of July 98 through to 31st of December 04, which all being well is another 78 months. And then we had that extended period for the rest of the time, i.e. from the 1st of January 05 through to the 30th of June 20. So we need to work out how many months is that in total and what will happen given that there was no actual occupation that existed. But of course what you have is the last 9 months prior to that date of disposal will always be exempt in this situation. So that's 9 months of deemed occupation. And why weren't you living in the property? It was, of course, because you were working elsewhere in the UK. And as we said, and it would be implicit, it will probably be explicit in your question, that at the time of sale, the individual still worked elsewhere in the UK. Then, whether it's work elsewhere in the UK or overseas, you are not required to return to actually live in that property prior to sale to benefit from the period of, here, 4 years for work elsewhere in the UK, or of course if it were overseas, any period of time working overseas. So we get that 4 years for working in the UK. What we don't get is the 3 years for any reason there. The reason being there is no actual occupation that has occurred following that period of absence from the property and prior to disposal. So if in this question you had been told here that instead of, went away to work, continued to work all the way through to and beyond that date of disposal, and you were told instead that 6 months prior to the disposal returned to the property and lived in it, that 6 months of actual occupation was covered by the last 9 months of ownership anyway there. But it would mean that in addition to the 4 years for working in the UK, we could add on to that a further 3 years of deemed occupation because we would have the 3 years for any reason. Because we lived in it at some point before leaving the property, we had then lived in it after we had lived in it after the period of non-occupation and prior to disposal. Therefore, you could have the 3 years for any reason. So that would mean, therefore, that we would move some 36 months out of the chargeable months and back into the exempt months column. But that didn't happen here, so these figures are as they stand, which again, do check through just in case I've made a mess of the calculations of months in however many years and months there are there for each of those periods. Check that through. Let me know if I've got it wrong. And we then do this calculation, that the private residence relief will be equal to. So what's the gain? 140. What was the total period of ownership? 291 months, of which 162 classified as occupation, classified as being exempt, whether through actual or deemed occupation. Put that through your calculator, and all being well, the result will be that figure. That is your private residence relief. That therefore is deducted in then establishing what will be the chargeable gain. If we were told that was the only disposal made in the tax year, and we then had to compute the CGT thereon, then what we would know is that we'd have an AEA to go against that gain. The remaining gain would be entirely, the remaining taxable gain would be entirely in relation to residential property, and therefore would face the higher CGT rates. Clearly, to know whether it was 18, well, there's bound to be some 28% given the amount of taxable gain that will arise. Whether there's any 18%, that of course will depend on the level of taxable income that the individual had on their income tax computation. But we didn't have to work through to a CGT figure here. We only needed to calculate what was the chargeable gain. That will always be taken there post the private residence relief. Okay, that has gone on rather longer than I thought this lecture would. You might be thinking it's gone on far longer than you wished it had as well there. But what we'll do is we'll bring this one to a close because we've got a bit too much left to do. There's only a couple of issues left to deal with, but it does include an example, and that would make this particular session very long. So in our next, and what I promise you will be the final session in terms of this particular chapter, we'll be looking what happens if there is exclusive business use of some part of your property. You use it for work and only for work there. Clearly, that's going to mean, well, it ain't your private residence now, it's a business property, and on that basis, you will lose the private residence relief. What happens there? And also, what happens in terms of something called letting relief? Now, again, if you've done this before, be careful because this has changed quite significantly. So don't just think, well, I know about that, I won't bother with that little bit, I've heard it before. Come back and join this lecture again, or this this chapter again here, because where that is applied has changed. It has reduced it again hugely there as to where letting relief will be available. Will now only be available where you, the individual, actually still live in that property and you're letting out a part of the property. Basically, you've got a lodger. Prior to Finance Act 20, we had the situation where you could be working elsewhere in the UK. You could be, well, that's the only problem where it would be probably applicable, or away for travelling or whatever. And if you had let your property out, you didn't live in there, but you've let your property out, then a further deduction known as letting relief would allow you to further reduce any chargeable gain that still remained post your private residence relief. That has changed. You now only get letting relief, as we'll discover in our next, hopefully relatively short final session. You only get that where you actually, the individual, live in the property. So only where you live in it, you've got a lodger. You're letting out some part of that particular property. That's a fundamental change. As we've said many times before, things that change often get picked up in terms of the next round of examination questions, so it's something we need to know. But we'll tell you all about that and a few other bits and pieces in our next and indeed final session on this particular chapter.